The debate may be heating up, but if bond markets have their say, there is no risk of runaway inflation. Joining us now, Invesco's Christina Hooper and Jim Bianco of Bianco Research. Christina, I want to start with you. Given that Treasury yields have fallen precipitously, on pace for their biggest weekly decline in a year, are they correct that inflation concerns really are transitory and the Fed is correct?
Well, they think they're correct for right now, and that's all that they know. We don't know whether inflation, this big pickup in inflation, is transitory or more persistent just yet. And so their best guess is to follow the Fed's counsel, which is that they are expecting a surge in inflation, but they're expecting it to be transitory. And so finally, markets are trusting the Fed. And I believe that the Fed really has changed its inflation targeting policy. When it implemented flexible average inflation targeting last summer, I don't think there was a recognition of what a significant paradigm shift it was and is. But now there is a growing recognition of it. So it really doesn't matter if inflation is transitory or persistent. It matters what the Fed thinks about whether inflation is transitory or persistent. And that's what markets are finally getting.
Jim, what's your sense?
I think if we take a step back and we remember that the bond market is bought by bond investors, I know that's a wild thought to think. The first quarter was the worst quarter in history to own bonds. You lost 16% in the 30-year bond. Through Wednesday of this week, you were still tracking the second worst year ever. We started the year under 1%. Now we've gone down to 145 and everybody's screaming there's no inflation. Sounds like a pretty bad year to me to be a bond investor. Sounds pretty consistent with the idea that the market is somewhat worried about inflation, but we've had a decent rally in the last week or 10 days, and we've seen a big narrative shift. If you're bearish, I think this is what you want to see for people to kind of get out of this whole idea that inflation's going up and get solidly into the transitory camp. So what I see is a bond market trading on its flows and dynamics, and I don't see a bond market yet reflecting that there's transitory inflation. If it was, we'd be back down at 1%.
So Jim,
if they really thought that there was transitory inflation.
Am I hearing the sense that you're shorting treasuries here?
Yeah, no, you're hearing the sense of a person who's been bearish on treasuries all year. I'm not unhappy with that position because, like I said, it's been the third worst year ever. And I am surprised that we've seen a rally in markets over the last, 10 days or so. But it hasn't done anything to change my opinion about where the economy is. Look, Treasury yields do not determine where inflation is. The data does. And one thing that's consistent about the data is it's been not very good. In the last 90 days, we've had 2% inflation just in the last 90 days. And so we've got an annualized rate in the last 90 days of 8% inflation, way more than anybody thought. And that's what worries me, is that we're still not appreciating how much inflation is actually in the system.
Christina, is that your view, too, that basically markets are overly sanguine about the inflationary risks and that bonds are poised to sell off once again?
Well, they certainly, yes, I do think that there's some truth to that. But the reality is that markets are just following the Fed's guidance, and that seems to be a good path to follow right now. I don't think that the Fed is going to budge and start raising rates in the next few months. I think that I think the timeline is pretty obvious, that we're going to get an announcement at Jackson Hole that tapering will commence in the fall. And I think it will be rather orderly. And I don't think the Fed will flinch with higher inflation because it's focused on a variety of goals now. It's not just about inflation. It's concerned about employment and reaching full employment and all kinds of things that were less important to the Fed in the past.
As we were saying, U.S. Treasury yields heading for their biggest weekly decline in a year. This prompted TD's Priya Misra to short the 10-year ahead of next week's Fed decision. She writes the following, quote, "The median 2023 dot is likely to move higher, and the Fed can start talking about the conditions and timing of its exit. This should come as a surprise to markets, which are priced for a dovish Fed. Certainly that's what it seems based on the move so far this week." For more, let's bring in Bloomberg's Kaylee Lyons. Kaylee.
Yeah, they certainly are, Lisa. Riddle me this one. We get 5% on headlines headline CPI, the core metric, the highest since 2008. And instead of a sell-off in the bond market, we get a rally with yields moving lower by about 6 basis points after that data yesterday. Again, we're ticking higher today. We're up about 2 basis points now. But with the declines we saw on Tuesday and Wednesday combined with yesterday, it all adds up to a drop of about 9 basis points on the week, which is the biggest weekly move to the downside in an entire year, as you said, since all the way back in June of 2020. Now, granted, it looks like a lot of this may due to a bit of a squeeze, shorts unwinding their positions, but it also speaks to a bond market that seems to be buying what the Fed is selling and viewing the inflation spike as transitory. Now, we see that reflected in break-even rates as well, which shows us how the market is gauging price growth on different time horizons. And across the board, those have come down over the last week. The 2-year break-even rate, which of course is the nearest term, has fallen by about 10 basis points, and longer-term inflation expectations have fallen too. We're down about 7 basis points on the 5-year break-even, 6 basis points on the 10-year, and of course, those longer-term break-even rates are much lower than that on the 2-year, which again underscores that whole transitory idea, Lisa.
Kaylee, thank you so much. Christina Hooper and Jim Bianco both still with us. There is a question about the feed-through effect of these lower yields on equity prices, on risk assets, on this flood into more yield. And I'm wondering, Christina, whether this concerns you, this idea that the Goldilocks narrative can only continue for so long. Does the risk that's building on the backs of these low rates present risk or opportunity to continue to pile into that trade?
Well, I certainly think it's having an impact on which part of the stock market is performing well. So we've certainly seen a resurgence in tech performance, relatively speaking, in recent days relative to cyclicals and value. And I think a lot of that has to do with lower rates, making valuations more attractive on tech names, for example. But I think that we've already lived through yields going up this year. And it was okay. The stock market didn't crash. Yes, could we see more volatility? Absolutely. I think we'll definitely see it as we get closer to the Fed making announcements and doing more to lay out its timeline for tapering. But I don't worry about the stock market. I think, this is just a normal part of what happens when an economy recovers. And we do go through some anticipation about what central banks are going to do, and it does impact markets. But we need to look at the long run. This is and also we need to take a step back. This is an economy that is improving. If you had said to me a year ago, this would be the scenario we'd be sitting in right now, I'd be pretty happy. We're seeing a strong recovery with elevated household savings.
Yeah.
We have increased confidence. We have so many things going for this economy. So, no, I'm not worried.
And I will say that this is a good argument for stocks. I don't know, though, about credit. And, Jim, I want you to weigh in. I was looking this morning at junk bond yields, which had fallen to 3.89%. That is 1 basis point tied with the record low, sub 4% junk bond yields. The pace of sales has been off the charts this year. At a time when we may be at peak growth, does this concern you? That people are pricing to perfection the levering up of corporate America?
Well, they're pricing to perfection in a lot of things as well, too. Not only in the junk bond market, but in the investment grade market as well, too. Those are very close to all-time lows, not quite there, but very close. And the stock market's valuations are some of the highest that we've ever seen, being justified by huge earnings as well, too. But I think when you step back and you look at it, yeah, it is a little bit worrisome because anything that could come along and upset this, growth disappoints, interest rates go up, some kind of unforeseen event, this market is not, or all these markets, especially high yield, are not ready for it. Now, the one thing the high yield market has going for it and the IG market has going for it is the perception that there's a Fed backstop. You are co-investing with the Fed. They're not there now. But the perception is that if those markets ever got a little sloppy, they would come right back and start buying those markets in mass and cushion you. So that is also reducing a lot of the risk premium in there.
Jim Bianco, Christina Hooper, thank you both. You are both sticking with us. Christina Hooper and Jim Bianco is still with us, and there's a question of all the political uncertainty, the political speak, and whether it actually matters. Jim Bianco, does it matter to anyone in the market what comes out of the G7?
I think there's only, from an economic standpoint, one thing that matters. How are we going to do global vaccination? That is the thing that we need to kind of get the entire global economy back on track. The Biden administration announced 500 million doses for the rest of the world that they're going to purchase and distribute. That's a good start, but they have to continue to move forward with that. As long as we have big COVID cases outside of the developed world where we have high vaccination rates, we're going to have a hard time getting everything really back on track.
So if there is a high vaccination rate, how does that change your investment thesis, Jim?
At that point, I think you could probably see the emerging markets and a lot of other markets, which I know have been performing fairly well, start to realize the potential that everybody is pricing in for them right now. They're rallying on the hope that we're going to get that high vaccination rate, that we're going to see far corners of the world starting to return to normal. And if it doesn't happen, it can be a disappointment. So the idea is we're buying the rumor that we're going to get everybody back to normal, and we got to hopefully get everybody back to normal. Otherwise, it's going to be sell the fact that it didn't happen.
We're watching images of leaders from around the world walking on the Cornwall beach for a family photo opportunity. Christina Hooper, I pose this to you. Aside from the vaccination and the pace around the world that we see of moving beyond the pandemic, there is a question about policy and how it affects investment. And I'm thinking of taxes in particular. How much are you paying attention to the potential implementation of the global minimum tax rate?
Well, of course, we want to follow it, especially since it's a cause for concern among some investors, right? They're asking questions. They're worried about what the impact might be to their investment portfolio. But the reality is we are a very long way from anything like that actually happening. Certainly, the G7 was quite surprising and certainly viewed as a positive development that they were all able to come together and agree to a minimum global corporate tax. But the reality is that after they formally approve it at the G7 meeting, there are many other steps, and it's non-binding. So I'm not too concerned about it, but certainly we want to be well-versed and follow it closely just because it matters to our clients.
We're looking right now at images of Mario Draghi of Italy joining Boris Johnson of the United Kingdom and his wife for a photo op on the shores there of Cornwall on the G7 summit. And Christina, I want to pick up on what you're saying, which is that this policy, there are a lot of additional steps that have to be made before those taxes go into effect. Perhaps the direction is a little bit clearer in the United States, where their policy is likely to be passed for some sort of infrastructure spending. Jim, how much are you paying attention to that and the prospective tax rates that people say are not exactly priced into markets yet?
Well, in the U.S., I think that, you're right, that there isn't a big pricing in of the potential of a 43% capital gains tax or any other type of tax increases as well, too. Largely because I think in the U.S. we have a 50-50 Senate, and the belief is that that's never going to make it over the finish line. So it does potentially have a surprise for everybody. I'll agree it's probably not going to happen in the form that we think it, or the form that it's been proposed. But there is definitely a risk that if a Joe Manchin or Kyrsten Sinema did change their opinion and you'll go along with it, that we can see taxes kind of surprise everybody in the U.S. and be higher and faster than we thought.
What do you think, Christina? Is this something that you're paying attention to in terms of rejiggering your equity expectations, with some people expecting a correction? I'm thinking Morgan Stanley's Mike Wilson among those, expecting a correction on a tax rate of 25%.
I actually think a tax hike is unlikely at this point. Of course, we want to follow it closely. It would be included in a list of potential risks to our outlook. But the reality is that I think it would be very difficult to get something like that accomplished. So we'll want to wait and see and follow it closely.
All right. Well, Christina Hooper and Jim Bianco, hold tight for 1 second. Right now, we're looking at Boris Johnson and his wife, Joe and Jill Biden, standing next to him, the United Kingdom and U.S. leaders there. We have seen Mario Draghi. We have seen the Japanese Prime Minister, Suga. We've seen a number of leaders, Angela Merkel also arriving, and just Mario Draghi. We have seen the Japanese Prime Minister Suga. We've seen a number of leaders, Angela Merkel also arriving, and Justin Trudeau now coming down the gangplank. There is a question here about the market response, and actually, as the G7 has gone on, the euro has actually weakened versus the dollar, with the dollar strengthening, and perhaps there is some implication, although it's unclear what the policy would be. Jim Bianco, is there a currency policy or anything of that nature that could stem from these meetings, or is the move that we're seeing in foreign currency driven entirely by monetary policy?
Oh, I think right now currencies are being driven by monetary policy and the perception of monetary policy. There's nothing that I'm aware of that they're going to talk about that, unless it comes out of left field, that it's going to be any kind of a significant move for currencies. They're going to talk about politics. They're going to talk about global warming. They're going to talk about
coming down the gangplank. There is a question here about the market response, and actually, as the G7 has gone on, the euro has actually weakened versus the dollar, with the dollar strengthening, and perhaps there is some implication, although it's unclear what the policy would be. Jim Bianco, is there a currency policy or anything of that nature that could stem from these meetings, or is the move that we're seeing in foreign currency driven entirely by monetary policy?
Oh, I think right now currencies are being driven by monetary policy and the perception of monetary policy. There's nothing that I'm aware of that they're going to talk about that, unless it comes out of left field, that it's going to be any kind of a significant move for currencies. They're going to talk about politics. They're going to talk about global warming. They're going to talk about the relationship with China. None of this should really affect the dollar-euro exchange rate.
I'm wondering, Christina, from your perspective, is the ECB kind of hamstrung when it comes to acting ahead of the Federal Reserve? This has been sort of speculated about. We saw the ECB take a very dovish tone in its meeting yesterday. A lot of people saying that it will be unable to move ahead of the Federal Reserve as the Fed meets next week. What's your view on that?
I think that's true. I think that the ECB seems very much, when you listen to what they're saying, it seems very much like what we're hearing coming out of the Fed. And I think that is likely to continue. I think many major central banks want the Fed to be the first mover on changes in policy.
So given that, Christina, are you opting to go more toward Europe than perhaps in the past, because the easy money policies are going to stay for longer, and because there is this lagging recovery, lagging with respect to the United States?
Well, actually, I'd argue that European equities look attractive for other reasons. Europe is behind the United States in the recovery, but it looks to be following in its footsteps. So you could argue there are a bit longer legs there. In addition, valuations look more attractive in Europe. So there are some good arguments. I don't think there's going to be a big time lag in monetary policy between the Fed and the ECB.
Jim Bianco, are you seeing opportunities in Europe right now?
Yeah, I think, as Christina said, Europe had lagged the U.S. in vaccinations and getting their economy going. That is now changing, and they're finally starting to catch up, and that is a good thing for them. And it is inspiring, a lot of investment flows to move back there, that they've finally gotten it on track, and they're catching up. I mean, aside from the UK, which had always been kind of the leader there as well, too. So, yeah, I can definitely see where Europe is going, and that it is going to be very good, at least on a reopening basis.
Just a couple minutes here until the opening bell in New York. Just want to give you a sense of where we are. Basically, NASDAQ pretty much flat heading into the open. The S&P up about 7 points. Not a huge move one way or another. Yields marginally higher, although still yesterday was the incredible downdraft in yields, up in price. And then the euro actually steadily deteriorating, 121.27. Christina, what's your highest conviction bet heading into the second half of the year, given the fact that we've already seen a bit of a give up in the reflation trade concept?
Well, I would argue that global smaller cap stocks, especially if we see a better, faster rollout of vaccines globally, I think that the small cap global stocks, more cyclical global stocks could really benefit. And primarily outside the U.S. As Jim touched on before, vaccines remain such an important policy issue right now. And to get that rollout quickly, to try to stem the tide of variants being created is absolutely critical. So if we do see that expedited vaccine rollout, I'd be very positive on international small caps and cyclicals in general.
Jim, your highest conviction bet?
I'm not going to give up on the inflation trade. And I think that by the end of the year, you're going to see interest rates higher, and you're going to see more of a belief that is not what we have now, that there is some more permanence, not permanent, but permanence to what we're seeing with inflation, and that it isn't as transitory as we think it is.
Christina Hooper, Jim Bianco, both of you, thank you so much for taking the time.